Hey everyone, and welcome to the Creative Financing Podcast. I'm Nicole Kamanjian, I'm here with Cody Richard, and the host of this show, Jeff Rappaport. This is episode 227, and today we have a special guest, Nick Legamaro, who is going to be covering buying and selling notes. While listening to this episode, if you guys have questions, please head over to the Creative Financing Podcast Facebook group. If you're not part of the community, just search the Creative Financing Podcast in Facebook and ask to join. There will be a live session on the second Thursday of every month, so bring your questions. If you're watching this on YouTube, you can ask your questions in the comments below. Lastly, we want to thank you for subscribing, liking, and sharing the podcast with your friends.
We have a special guest, kind of near and dear to my heart because he's my coach and my mentor right now, and I'm super happy to have you on today. We have Nick Legamaro. Did I say that correctly, Nick?
You said it better than I usually say. That's and I've been messing that name up for 50-something years. So it's all good.
So Nick's going to share with us some really creative financing strategies. And the whole reason why I decided I wanted to work with Nick was I've been doing creative financing for 20 plus years, but I've never sold any notes. And when I saw what your strategy was, I just saw how many more opportunities it can open up to a real estate investor. And I thought I better learn more about this. There's probably no better person to learn from than Nick. So
well, I appreciate that. Well, I will tell you this, the advantage that you have over me, it took me about 500 notes and cost me about $6 million. I didn't lose $6 million, Jeff.
I've heard this story.
Opportunity to make $6 million more, and we'll get into that when we get into the breakdown of it. But that's the benefit of learning from whoever said learn from your own mistakes is a fool. Learn from other people's mistakes and do a better job of it. And that's the advantage that people that are listening, because you said you've been in this business 20 years. I've been in it over 20 years. 20 years ago, we didn't have podcasts, Jeff. We didn't have Zoom.
We didn't have internet, I don't think.
No, I think it was just coming out.
Yeah, no one was using it.
I tell you what, we didn't have REI groups. We didn't have meetups.
YouTube.
We didn't have YouTube. We didn't have all these things that really expedite the growth of what we're trying to accomplish from it, not only from a business perspective, but also just from a learning curve, right? I mean, if I knew what I know now when I started, or had the ability to this, I can promise you we wouldn't be having this conversation right now because I would have already been on the beach somewhere, right? So the guys take advantage of the education. I think what's really, really important, I like people always ask the question, I'm just going to answer right now, what would you tell somebody, right? And it's like, take advantage of what we're talking about today. You've been in this business for a long time. I have been as well. And we still seek education, and we still seek out mentorship and coaching because we don't know what we don't know. And it only takes one idea to impact your business by millions of dollars potentially. And I still pay thousands and thousands of dollars a year to be a part of masterminds and mentorships because it helps me grow. And what's really unique about this, and we'll get into the story, is that we're sort of on our own little island in the real estate world, right? When real estate, we're our own everything. We sort of learn to do everything ourselves, from finding the deals to funding the deals to fixing the properties or whatever it might be. And so it's always nice to be able to share stories, and because we don't have the benefit of being in a corporate environment per se, or in an office with other coworkers where we can share ideas and break deals down and things. We're sort of on our own now. So anyway,
I always find it important to, if you're not adapting to what's going on in the market, you're probably going to end up in a place you don't want to be. And because the market's always changing, maybe slightly, maybe more than slightly, maybe significantly. And the thing that I love most about creative finance is I've always figured out a way to use it no matter what, right? The
Yes.
market's great. It's a seller's market. It's a buyer's market. It really does not matter. Although
Correct.
there are times where it's even better. And
Yeah, I think we're gonna find that out real quick here, because what we're getting ready to experience. I was around in 2008. I think you were too.
I was.
It's a whole different animal out here now. And I think what we're going to find out is the opportunity is I'm super excited about where we're going compared to where we've been. To be quite honest with you, maybe we can get into that a little bit too.
Absolutely. Well, why don't we start with how you got started in real estate, where you started, and what's been the career path, and what's kind of led you to, and we'll talk about where you are now and what you're doing. So, give us a little history of yourself, Nick.
Well, I've been, like I said, I've been in real estate since about 2001. So I pretty much have done everything that there is to do. Some things I did good or did correctly, and other things not so much. And when I first started, like I said, I didn't have access to all the stuff, and I got involved with an individual that was buying at the time. They were buying, because you could do this. You could buy portfolios from banks back in the early 2000s, right? Doesn't happen anymore. You're not just going to walk in. So she would buy portfolios, and then she'd chop them up into small little 2 and 3 house portfolios, and we would buy them, and I would fix them, and then I would sell them to an investors. And I started going down that process, and I learned a long time ago how easy it is to over rehab, how to have your how to have delays in finishing, being over budget and under, whatever, right? All the things that you don't ever forecast in the model. Then '08 hit. And I was very fortunate to get out fairly unscathed. I mean, it hurt, don't get me wrong, but I didn't see where it was going. And it hit pretty quick, man. I had stuff at the closing table. I was going in the day that I don't know the exact day it happened. It was like sometime in August of 2008. I have to look at the day. I literally had 3 deals at the closing table. 2 I was buying, 1 that I was selling, where they never funded. The funding companies were gone. They literally had locked the doors, and there was no more money to be given out. It was gone. So
I remember.
It was crazy. I mean, people, it's funny, whenever I go speak to in front of groups and stuff, one of the first questions I always ask the audience is, how many people were doing real estate before 2008? And usually, even in a group of 200 or 300 people, the number of people you can count on 2 hands. It's just not that many. So they have no idea or have any understanding what we're talking about here. So maybe I always get, made fun of being the old guy, but hey, now the old guy has some value, and hopefully we can share this. So anyway, so I did a lot of stuff up to 2008. Then I got out of real estate, and I went back to corporate because I was scared, man. I didn't know what to do. I wasn't prepared. I had no idea how to react. So I sort of sat on the sideline for the better part of the year, and I go, this sucks, man. I want to be doing real estate, because that's where you can generate and really build wealth. I knew that already, man. I learned that a long time ago, but I was scared. I didn't really know what to do. So long story short, I go, well, you know what I'm going to do? Because by this time, when 2010 comes around, there is a lot of information out there. There is data, there is education. And I go, I'm going to forget what I know, not really forget, but try to forget what I know and try to evaluate opportunities. And one of the first things that I got back involved in was wholesaling, because conceptually wholesaling makes a lot of sense, right? You can leverage. There's not a lot of expense. There's not a lot of risk, and it's a wholesaling, especially back then, was a very good model. So how I got in, so I go, you know what? So that's what I did. So I bought a list, just like most people buy. And I sent out yellow letters and postcards. That's what we did. We actually did yellow letters and postcards. Today they do some other variation of it. I didn't have a lot of money, Jeff. I just came out of this, fiasco. I drained down most of my retirement funds because that's the only thing I had left. So I wasn't making money in real estate. And I sent out this list and I get a phone call. And this is in Dallas, Texas. I'm in Austin area now, but this was in the Dallas area in about 2010. So 12 years ago, not that long ago, but a long time in the real estate world. A lot of things happened since 2010.
Yeah.
It seems like an eternity, but in time it really hasn't. But back then, you could buy a cheap house for $20,000, $30,000, $40,000. That same house today is over $100,000. So, and I had a very narrow mentality and of what I thought I could do. I had limiting beliefs on what I thought I could accomplish and what I did. So I sent out to a list and I went after low dollar houses because I didn't really have the forward thinkingness to be able to say, well, I can leverage, I can do a lot of different things. I thought I was going to have to use my own cash. And I didn't have a lot of it, to be quite honest with you. So I try to keep it limited. So one of the very first calls that I got off this mailing was a lady that had this little 2-bedroom, 1-bath, 700 square foot POS down in South in the Grand Prairie area, which is a suburb of Dallas. And I go, how much do you want for the house? I did everything wrong. First of all, I didn't even know what I was doing. Asked all the wrong questions. I go, how much do you want for the house? I think the first thing I asked her, and she goes, well, I want $25,000. I go, $25,000? And because I had no idea what $25,000 was even worth. I go, let me go look at the house. She goes, well, you can't. She goes, please do not disturb the tenants. How many people have ever heard that before, right? Don't disturb the tenants. I go, okay. She goes, they don't know I'm selling the house. I don't want to make them mad. I go, okay, I won't bother them. I'll just drive down the street. She was retiring from General Motors. She wasn't living in this house. She was moving to California and be closer to her daughter. So I drive down the house and I'm looking at this house and I look at it and I go, oh, I guess that's what a $25,000 house looks like. Now I knew what it was. Yep. So I'm driving down the street. And I get to the corner and I'm just driving the neighborhood. And I saw a Vende Casa sign. And I know enough Spanish to be dangerous. I know what Vende Casa means. So I call the phone number and I go, she goes, hola. I go, hello, do you speak English? She goes, yes, I speak English. I go, hey, I got this property for sale. I saw your sign at the end of the street. I was wanting to know if you'd be interested in buying or know somebody that would. And she goes, I might. And I go, okay. And she goes, I give her their address. I go, but hey, they can't disturb the tenants. Okay. I'm not letting them know I'm selling the house. She goes, how much do you want for the house? And I go, $35,000. I have no idea what thing's even worth yet. This is literally happened. Just swagged it out there. She goes, okay, I'll call you back. Didn't think anything of it. This is literally one of the first phone calls I got that was of any consequence that we thought we may be close on. So I'm literally driving back to where I was living at the time, and I get a phone call. And she goes, hey, Mr. Nick. I go, yes. She goes, I got buyers at your house right now. I go, oh crap, buyers at my house. She goes, don't worry, they're not going and disturbing anybody. They're just looking around the outside. They said, since they can't get inside the house, they would want to know if you would take $32,000 for the house. And I said, $32,000, like I'm insulted or something, right? I don't know. Let me think about this. I don't even have this house under contract yet. Yeah. I don't even have it. So, but I'm doing the math and I go, well, and how much do you want? She goes, I want $2,000. Okay. And I go, okay, 32 minus 2 minus 25 is $5,000. I don't know if that's a good deal or not, a good deal or not, but I do know that's $5,000 more than I had 2 hours ago. Right. And so we literally did that deal. That was one of the very first deals that I did.
It's funny.
So same mailing, and this is where the creative financing side comes in. I get another call and it's very similar, a little nicer POS. Okay. But I asked the lady, she goes, I want 20. It was almost the same numbers, probably because I mailed to the same type of property and list, right?
So they're probably worth 30 grand.
So not anymore than that. But so she goes, I want 20 I think she said $23,000. Like she goes, all I want to do is pay off the bank. I don't want to be here anymore. I got divorced. And she had a bank note for $23,000, basically. This is before I knew what I could have done at that house. So I said, okay, fine. So I call Lydia up again on the phone. I go, hey, Lydia, this is like a week later. I go, hey, I got another house. I go, this one's a little bit nicer though. It's probably worth $50,000. And my narrow thinking at the time, and this is why I wanted to get to this point, is that, well, she just had a buyer for $25,000-$30,000. And I said, well, it's worth 50. I owe 23. I give Lydia $2,000 again. Well, I'll just carry the difference on if I'll sell for 50 and I'll carry the balance for $25,000. Not thinking that she would even have a cash buyer for it. Thank goodness that I didn't ask that question, because we'll get to that point in a second. So I go, hey, I'll be willing to carry this back if you can get somebody who gives me $25,000 down. And sure enough, that's exactly what she did. She got $25,000 because that's what I asked for. Instead of asking the question differently, what could you do? Right. And so I get a deal. I write a phenomenal note, Jeff, that I think you'll appreciate this. I think it was I ended up selling it for like $45,000, like a $20,000 note on a 5-year, on a 5% note, on a 5% interest rate, like on a 10-year term or something like that. It was something, the note's way long gone. And I go, okay, well, that worked out okay. So then I got a little cash flow. And so then I call Lydia and I go, Lydia, I started thinking about this, and I go, and this is before I really even knew anything about creative financing, deal structuring in general. I said, let me ask you a question. I go, you just found a buyer that gave me $32,000 cash, and you had another buyer that had $25,000 cash. I don't even have $25,000 cash that I can be responsible with. What's going on here? I go, how many buyers do you have like this? And she gets out, I can't make this stuff up, I'll show you. So she gets out a spiral notebook that looks like this, okay? And she starts flipping it page after page after page with name, telephone number, and how much cash they have down. And I'm looking at hundreds of names, $10,000, $20,000, $100,000 cash that they have to put into a property because they can't go down and get a bank to give them a loan.
Yep.
So then I said, well, let me ask you a question. If I can find you nicer properties that are worth at this time like $100,000 or $120,000, can you still get me $25,000 down payment on a nicer house? And she goes, absolutely. And from there, that's how we started creative deal structuring and financing and providing home ownership to, hardworking families that can't go down to Chase, Fargo, or Bank of America and get a loan and create mortgage notes. And that's what we started doing. We started building this whole business about finding properties, buying the properties, fixing the properties, depending on what that ever meant at the time, and then going and finding these seller finance buyers to go and create the note. And then what we would do back the first 500 of these notes, we would sell the note. We would sell the note off. It was 100% transactional. And we would sell that note off to a fund or a financial institution or something like that. And we would get 85, 90 cents on the dollar, depending on the asset and the structure and stuff like that. And it was 100% transactional. Well, that was great. And we made a lot of money doing it. We made much more money. That's not right. We made more money doing that strategy than if we would have done a traditional fix and flip, when you do the time, the holding cost, the velocity of capital, all these things that you look at, and it just made more sense. Plus, we were helping families that couldn't get home ownership. So it was a win-win all the way around. Well, we did that for a while, and then getting into where we're going to talk about is when we create the first and the second notes. And what I learned is that there's a point of optimality where you can get maximum value. Okay. And the maximum value is somewhere around from a note buyer. And we'll get into the underwriting stuff here whenever we want to break to go on that. We would create this, we start creating a first and a second note. so that we wouldn't have to make this 100% transactional. We can just sell off enough of the notes that we created to pay off our debt to recapitalize the business so we can go repeat the process. So, let's use $100,000 note, for example. We might get 10% down, which is $10,000. And instead of writing a $90,000 first, like we used to do, and selling the $90,000 first, getting the cash and paying off the debt and keeping the profit, we would write maybe a $75,000 first, right? A $15,000 second note and a $10,000 down payment in this example. We take that $75,000 first, we'd sell that. That would pay off our debt, and our profit would be some of the cash from the down payment, which is the cash now, and the cash flow, which would come in the form of the second note. Well, in just that little strategy alone, if we went back and calculated, if we had done that on the first 480 deals that we've done, it would have been the discount that we paid on that we gave up was worth probably $6 million. That's face value, Jeff. That's face value on the note. Anybody that understands what amortization is and how it works, on a 10% note at $6 million, that's probably could be as much as $18 million based on that interest rate. I mean, that's a lot of money that go into somebody else's pocket because we didn't have the creative structure that we do today. And that's where we are now. So just finishing the story. So I did that process, and that was with a company that I had called Rilix Capital. And Rilix Capital, we did this. My partner was John Montero. Anybody that's in the multifamily space now might know who John Montero is. He was my partner that I brought in from the very after he was actually my lender on my first 3 deals. And he goes, man, this is such a great idea. Why don't I just be a partner in this? Why would I want to be a lender on this? I could just get the benefit of creating these notes. And that's what we did. And we built this whole seller finance company that we ended up selling to a federally chartered bank back in 2018.
Oh, wow.
So the banks couldn't create what we did, but they could buy it because they were buying the notes anyway. And then they just ended up buying the whole thing. And, they did that. And that's where we did. And that's where we created. So, now what we do today is we talk about note structure and how to create a quality note that's consumable by financial institutions. Because here's the deal. Right now, the seller financing industry, most people don't know that. First of all, a lot of people don't even know they can be the bank, Jeff, right? Yeah. They don't even know they can be the bank. And if they don't even know what be the bank means, okay? Most people probably have had a mortgage at some point in time, and they pay Bank of America, Chase, or whatever. It's no different. So instead of, just like I used to have a loan with Bank of America and I pay Bank of America, now I have a loan with Bob Smith. Bob Smith pays me. I just reverse the roles, right?
Yep.
That seller financing, the seller financing world today, when I say that, of all the notes that are created annually right now that aren't written by Chase, Wells Fargo, Bank of America, the guys that everybody knows of, it's about $28 billion a year. That's $28 billion with a B, in an industry that you can talk to most people in the space and they have no clue that it's that big.
Yep.
And that's substantial. So that's all the stuff that we have the ability to take advantage of. But with that said, there comes a challenge for the people that are creating that paper, the educational side of it, where they don't understand ultimately what that means.
Well, let me summarize just real quick, Nick, because you just said a whole bunch. And so for our listeners, so you basically figured out creative finance almost by accident. Is that about right? It basically happened by accident.
Yeah, I would say I was very, very fortunate and lucky to stumble across, because if I would have known that back in that example that she had a book of people that had $50,000, $60,000, $100,000, I would have just sold it for cash.
Right. Well, and good for you to even figure out to ask for a note. So, I
didn't think they had the cash, so I didn't know what other options. So if I wanted to sell it, that was my only option.
Most people would just move on. They don't have enough cash, so I'm not open to taking a note. And I think what's really important with what you said is that what a lot of people don't understand. So a lot of people understand, hey, I can work out something creatively with a seller. I might not know all the strategies, but the seller can be my bank, or I can be the bank for a buyer. But what they don't realize, and it's funny because I talk to a lot of people about this, is that they don't realize that you can actually sell a note, right? That there are people that will buy your note. And then when they say, oh, but there aren't that many people that do that, right? And I'm like, no, there's a lot of people that buy notes. And
there's a lot of institutions by now. I would say that I don't know, I would say 95% of the Fortune 100 companies in this country, they have notes in their portfolio.
Yeah.
Every bit of it.
Yep. So
it's linear, right? It's flat, meaning the performance is consistent. It isn't like you have some up, and you don't have the up and downness of a stock portfolio or something else. It's very flat. I mean, doesn't matter when you're the bank, Jeff, and you have a note and you're like, it doesn't matter if the properties go up and down in value.
Right.
You're going to get the same payment.
Yep.
Now that's good and bad. It depends on what you're trying to do. If you're trying to protect, protect your capital stack, right? Then that's one thing. If you're trying to grow, that might be something different. But not everybody, depending on where you are in your investment strategy, you probably should have a little bit of both. You probably should have high risk, some things that are higher risk, higher returns, lower risk, lower returns. But what I love about notes more than anything is that it's securitized by the asset.
Yeah.
Okay. And it's amortized. I mean, those are two big things. Look, banks, this is what banks do. Okay. There's a reason why banks are in the banking business, period. They learned a long time ago they can get cash flow by controlling assets versus owning them. They don't own your house, Jeff.
Right.
They control it though, because if you don't pay, guess what's going to happen? They're going to go get that. They're going to either do some kind of workaround, or they're going to come back and take that property and they're going to go liquidate it and get their money back that way. That's it. So those are the golden handcuffs. That's what I love about it. Plus the other benefit of it, because it is amortized, and amortization just basically means I'm going to get all my money first and all my interest first, and then I'm going to let you pay down what you actually owe me. Yep. I mean, in simpler terms, right?
Yep.
So, go look at an amortization table, and depending on what the interest rate is, will determine. But let's just say, for sake of argument, and I don't want to go on a tangent, but let's say the monthly payment is $1,000 a month. That payment will not change for the life of the note, right? Doesn't matter if you pay more principal payment down. Doesn't matter if you do anything different. The payment will never change. The payoff may change. I mean, as far as how much you owe and when it does get paid off, but the term will never change until it's paid off. So $1,000 a month. So in the first month that's due, I don't have one in front of me. I'm just going to use a hypothetical example. $996 goes to the interest expense on that, and $4 goes to principal payment.
Yep.
Okay. And every month that goes by, a little bit more goes to principal, a little less goes to interest. Okay. Yep. For 30 years. So most buyers or borrowers, it will take them almost 20 to 23 years, depending on the interest rate, to get to the position where that $1,000 a month payment is half going to interest and half going to principal. That's how much front loaded it is on the interest side, which is what the benefit of being the bank is. So when because people go, oh my God, you get sticker shock. You go, I'm going to pay how much? I'm only borrowing $100,000. I want to pay you $290,000. Yes.
Yep.
Well, guess what? How does that feel when you're on the other side of the fence, right? And you're
much better
now. It's a much better feeling. So that's it. So
yep.
Anyway, I'm not going to get on too much on a tangent on that.
So I want to start to close this, but Cody, do you have any questions that maybe have come up for Nick?
There's a lot to digest for sure. I want to understand more about. You mentioned the Fortune 100 companies and how they're buying a lot of notes, like how those connections are made. And then you also talked about how structuring them so they're consumable by institutions like that and understand more about
We're
that.
definitely going to talk more about that in our next episode. But Nick, how about a little bit about what does a note buyer, what does a note buyer want to buy? And then maybe address the Fortune 500 companies.
Yeah. So, well, what the Fortune 500 companies or any financial institution or hedge fund, they're buying most of the time. That's what that's going to be more premium type paper. When I say premium, I'm talking about where it's more of the pretty buyers. I call them pretty buyers, right? They're the W-2 employee that has 2 dogs, 3 kids, lives in the suburbs, and works for
720 plus credit score.
Works for Frito-Lay, got a nice job and doing it. They're going to go get an FHA or a conventional loan, and they're going to go down to Wells Fargo, and they're going to do all the paperwork, and then once that's done, Wells Fargo is going to turn around and sell that note to a note buyer, basically. Okay. Anybody that's ever, the best way to look at it is, anybody ever had a mortgage note before? If you ever get a hello, goodbye, they call them hello, goodbye letters, right? Hello, I'm your new servicer. Goodbye, I'm no longer your servicer. It changed from Chase to Aquin or whatever it is to Mr. Cooper or, FCI or any of these different places. Well, that's what's happened. The note has been sold. Notes are sold very, very regularly. And it depends on, and there's a price for it. And the price and the value is determined on the collateral file. And we can talk about that on our next episode. So that's where the notes go from. And what was the other question, Cody? Yeah.
So you talked about, or go ahead. Jeff.
No, go ahead, Cody.
No, you had 2 questions. One was the institutional buyers.
Really, what are note buyers? What
are they looking for? Yeah. So
Mm-hmm.
the best way to look at it is the way I look at it. There's different kinds of notes. First of all, there's performing notes, there's non-performing notes, and there's reperforming notes. Well, non-performing note means it's performing, means the buyers continue to make their payment on a regular basis. Much more desirable than a note that you're trying to sell where the buyer doesn't pay, or the borrower doesn't pay on a consistent basis. The best analogy I can use is I compare it to, I'm in Texas, I use a Ford F-150 pickup truck, right? They're both 2015. They're both white with tan interior. They both have 50,000 miles on them, okay? So on the surface, they look to be the same. The difference is one of them has impeccable maintenance records. It's in pristine conditions. There's not a mark on it. And you have the, records of the oil changing, the brakes, everything. The other one has been on the farm and has been beat to crap, right? Which one's worth more money? Okay.
The well maintained, of course.
Which one do if you're buying those 2 vehicles today, which one do you have a higher level of confidence that it's going to perform to what you need it to do in the future?
Yeah, that makes sense.
No notes are no different. So the underwriting file, and we'll talk about that on the next episode, and the collateral file is the critical components of building this story, if you will, because most of the time we're writing this out for 30 years. And if we're writing it today, we have to use some of the data from the borrower then, but we also want to put the note in the best position to be successful. And that for that reason, it gets the maximum value on it. And that's it. And that's a lot of people, there's a lot of tips and tricks in that. We can talk about that as well on how to get the maximum value for a note that you want to create, whether you're going to sell it or whether you're going to hold it.
So last question, then we'll wrap this episode up. So note buyers look for a particular yield, right? A return on their investments, and
relative to risk though too, right? So it's not just the yield.
Right.
Yield is one number. A lot of note investors, I could call it, get drunk on yield. They're more enamored with the yield, and they're not looking at all the pieces to the puzzle. And that's where it becomes a challenge when you start getting into the non-performing space, because I have no desire to own any non-performing notes, because non-performing notes become a job and so forth. But that's the biggest part.
So they want to get a certain return, and then they're going to look at it from even another point of view, which is what's the collateral.
Yep.
What kind of conditions the collateral in, what's the area, what's the market, right? So in case of default, what would have to happen to get the collateral back? And then of course the borrower, right? Because these are not your pretty buyers, right? Your pretty borrowers. These are typically the ones that we deal with are going to be challenged in some kind of way, right? That they're self-employed,
Potentially.
potentially.
Well, at least in the eyes of the traditional lender, right?
Correct.
I can promise you there's a lot, the people that I've underwritten that are self-employed are a hell of a lot better borrowers than somebody that's a W-2 employee.
Yeah.
So you can't, just because they don't check the box like they want them to, doesn't mean they're not a good borrower, right? And I think that's the opportunity.
Yeah.
Now, you don't want to run out and go sell a $150,000 house and get a $500 down payment. I can tell you that, right?
Yep.
So there is some vetting that has to be done, and there has to be some level of investment, on behalf of the borrower, and have some skin in the game. But yeah, that's our opportunity. Look, if it was that easy to go get a traditional bank loan, Jeff, we wouldn't have $28 billion a year in seller finance paper being created. That's right. $100 billion in the last 4 years.
Yeah.
It's been created. I mean, that's a substantial number.
Well, and I think, the last thing is, what percentage of the population do you think, Nick, right now cannot go and qualify for a conventional mortgage? So that they need this kind of help.
Yeah. That's a great question. So I'm a sort of a stat nerd, right? So I'll give you 2 pieces of information. 3. I haven't seen the most recent number, but the last time I checked, the average declined credit score was about 708.
Wow.
Okay. Now, as for where I come from, there's nothing wrong with a 700 credit score.
Right.
Okay. But there's other factors besides credit score that determine your ability to qualify for a mortgage.
Yep.
That's number one. When COVID first hit in March of 2020, right?
Yeah.
March of 2020. If there was 100 files that had been approved for a mortgage, okay, in March of 2020, and then you fast forward to August of 2020, of that 100 that were qualified, less than 70% would qualify in August 2020. And the only thing, nothing changed in the borrower's file. Their job didn't change. Their credit score didn't change. Cash reserves didn't change. Nothing changed. What changed? The bank's underwriting guidelines.
Yep.
They got tighter. Okay. So as they get tighter, less people can qualify. The answer to the question, it's probably somewhere between 60 and 70% of the population that would want to get a bank loan cannot go down and qualify.
Which is
that's
crazy.
A substantial number.
It's crazy.
And the last number I'll throw in there, and you look at the available, this is why seller financing is such a great strategy, in my opinion, because you already know 60 to 70% of the population can't go down and get a bank loan. They need help. Okay. But here's the other thing that we know. If you go and you look at the amount of properties that are available to purchase with seller financing, it's not very many at all.
Yeah.
It's probably less than 5% of all. You go pull an MLS search or go on Zillow or Realtor.com.
And 5% is in Texas, where you probably see it more than,
Texas
you compare Texas
state,
to Utah, it's not even close.
So it's economics 101, Jeff. Okay. And then we'll wrap this up. So you're telling me out of 100 buyers, 65 to 70% need your help.
Yep.
Okay. And out of 100 houses for sale, only 5 of them are available for people that need, of the 70% that needs the help. Okay. So if you can provide the financing to the majority, and you have a limited supply, which is a seller finance house, that's a pretty good combination, in my opinion.
Totally agree.
How do you mess that one up?
Yep.
You got 1,000 times more buyers number wise than you have properties. It's supply and demand. That will never change, because guess what? As rates continue to go up, less buyers are in the marketplace right now because they go, oh my God, rates are 6%.
Yep.
They were just 3. They're no longer a buyer.
Yep.
Guess what? Seller finance buyers have never been concerned about.
Interest
The
rate.
3% interest rate at the bank.
Yeah.
They couldn't get it anyway.
Yep.
They were always paying 9.5% or 10%. So
Yep.
it's a great time to be looking at creative strategies and creative financing to be able to do this. And I don't think this is going to change. We have a unique opportunity to take advantage of this these changing market conditions for the very foreseeable future, in my opinion.
Awesome. Well, let's wrap this up. If you didn't find some kind of nuggets in this one, you're just not trying. But next,
that's for them. Yeah, you're not trying. Hey, so let me say this. If you're, we talk about creative deal structuring and strategy, and we have a private Facebook group. So if you can go to Facebook and search for Creative Deal Maker, and fill out a couple questions and get admitted to the group, and you can see, you see and hear what we talk about on a regular basis, and maybe it'll trigger some people to be able to go out and do some more creative strategies.
Yeah, and so we're going to have Nick back for the next episode, and we're going to go through his actual strategy. We'll look through going through his spreadsheet that he created, and you'll be blown away with what you can actually do. So yeah, go check out his Facebook group and get on his office hours too.
Yeah, come on in. The more the merrier.
All right.
Last thing I'll throw in is whether you're listening on audio or video, check out the description. We'll include a link to the Facebook group and then other resources if Nick has some to provide.
Awesome.
All right, appreciate it, guys.
Go out and create some terms.
Let's do it.